dissect that Fed decision now, joined in the studio by the acting group head of research and chief economist for Emirates NBD, Ed Bell. Ed, good morning.
Good morning.
Going to get your thoughts in a second. First of all, let's just remind ourselves what Jerome Powell, the head of the Fed, did and said last night. This is he.
Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged.
What was your take, Ed?
Yeah, I think the Fed chair is quite right to describe the economy in the U.S. as being in a pretty good spot. If we look at the jobs market so far in 2025, it has been evident that it's still positive, albeit a little bit slower. The disinflation path that has started in the last couple of years is still proceeding. Inflation is moderating, but when he's looking forward, and he was very explicit to say that the Fed can't be a policymaker that is only looking in the rearview mirror. It has to be looking forward as to the outlook for the economy. There are these huge uncertainties facing the U.S. economy, facing the global economy, as a result of the tariffs that were introduced since the Trump administration has taken power in the U.S., and what that could mean for the inflation outlook in particular. So I think that's really what is keeping the Fed on the sidelines for now, that they want to see an impact of those tariffs, of that disruption to trade in the U.S. economy. Because right now, when we look at the breakdown of data, if you look at inflation, it's not really filtering in. If you look at employment, we haven't really seen that creeping in any kind of material way, but everybody's waiting for it to show up. And so if they have the room where the economy is in a good shape to keep rates on hold, they might as well do it.
Well, this is what he had to say. He was asked in the press conference afterwards about tariffs, and he thinks this summer is when it might begin to bite. This is Jay Powell again.
It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months.
So lots of uncertainty, but we did get the so-called dot plot from Fed policymakers overnight. This is when all 18 of them give their predictions for where they think interest rates will be at the end of this year, next year, and indeed the year after. Rate cuts, but not many rate cuts. What was your take on that?
Yeah, so they kept the dots plot unchanged from their previous projections. So expecting 50 basis points total of easing, or that could be 2 cuts. At some point this year. For 2026, though, interestingly, they actually reduced the expectation from 50 basis points to 25 basis points of easing. So the outlook from the Fed is still that rates will go lower, and markets seem to be backing that up as well. I think what we had in the press conference is a question about what's the rationale for that? Because earlier in the year, it was that disinflation was going to remain intact, and the Fed could cut rates along with slower inflation. And now it's a question of, does the Fed need to actually cut rates to help sort of save the economy, because we're going to have a material slowdown in growth? So we had, along with the dots plots, new projections for GDP, and there was a meaningful downgrade to the outlook for 2025 to 1.4% real GDP growth in the U.S. That's down from 1.7. Now, that number itself doesn't sound like a huge shift, but if you think of, if they were starting the year thinking the economy was going to grow by 1.7, well, there might have been some top side to have growth up to, say, 2%, or maybe it could be, 1.5, 1.6. But if your median projection is 1.4%, then maybe your top side, the best you could get is like 1.5, 1.6, and your downside could be closer to 1%. And that's a lot of a more downbeat picture for the vitality and the momentum in the U.S. economy than we were projecting at the start of the year.
Well, one person who thinks the Fed should be cutting rates aggressively is Donald Trump, the president of the United States. He gave an impromptu press conference yesterday afternoon, just before the Fed decision, but hold was widely expected, criticizing Jerome Powell. This is Donald Trump.
He's not a smart person. I don't even think he's that political. I think he hates me, but that's okay. He should. He should. I call him every name in the book, trying to get him to do something. I've been nice to him. I do it always. I don't know how to sell. I've been so nice to him, fellas, you wouldn't believe. Let's have dinner. Too late? I'd call him too late. Come on, too late. Let's have dinner. I do it every way in the book. I'm nasty. I'm nice. Nothing works. He's like just a stupid person.
So Donald Trump says he wants rates to be 2 or 2.5% lower than they are. Is there a case for that, Ed, economically?
No, I don't think so, really, at this time. And I think what we saw from the Fed is that they're saying that where rates are still at the moment at 4.5 is in their terms still restrictive, right? So it is still constraining economic activity, and that was what was required to get inflation lower. And when asked about that during the press conference, I think that was why Fed Chair says that there is this room to be able to cut rates, that they do have some space because they are sort of overly tight right now. But to cut them by, say, 200 basis points would be far too stimulatory to an economy that is potentially on the precipice of a sharp increase in inflation. The Fed, their projections for what inflation was going to do is going to be 3% by the end of this year. Based on the metric that they're looking at right now, it's 2.1%. So that is a big delta to shift inflation that much higher by the end of the year. That's the scale of anxiety that they're worried about inflation. So cutting rates by that degree that the president has sort of spitballed out in the market, I think would be not appropriate for the state of the U.S. economy.
Finally, how appropriate is it for us here in the UAE, the central bank, immediately following suit last night? Our base rate is 4.4%. What's your take on that?
Yeah, it's a very interesting dynamic, right? Where we import monetary policy that is not in sync with the economic conditions in the UAE. But if we look at the economic performance of the economy last year, and really the non-oil economy growing by 5% in 2024, when rates were higher for the most part than they were towards the final quarter of last year and higher than they're projected to be this year, it does show an economy that can withstand and absorb rates being higher. So there's a lot of growth momentum in the UAE economy across multiple sectors. The retail spend looks very strong. Project spending is strong. Real estate transactions are still doing well. So there's multiple channels of momentum happening here that can withstand rates being elevated for a prolonged period.
Ed Bell is the acting chief economist of Emirates MBD. Always good to get your thoughts, Ed. Thanks for joining us in the studio this morning.